Stop. Before you click away, I need 60 seconds to show you something that will fundamentally change how you see money. Right now, as you're watching this, there are people who know a secret about 2026 that you don't. They're moving millions out of banks. They're buying something the government desperately doesn't want you to own, and they're doing it quietly before the window closes. In exactly 413 days from now, something is going to break in the financial system. Not a prediction, not a theory. A mathematical certainty based on debt cycles that have repeated for 5,000 years. And when it breaks, the people holding paper money, the people trusting their savings accounts, the people who waited for permission from financial experts, they're going to watch their purchasing power evaporate in real time, while a small group who understood the game walks away wealthy. I'm going to show you exactly what they're buying, why central banks are terrified of you finding out, and the specific amount you need to protect yourself before this thing goes nuclear. But first, I need to know you're ready for this. Where are you watching from? Drop your country in the comments right now, because what I'm about to reveal is happening simultaneously across every continent, every currency, every banking system. And if you want the unfiltered truth without the corporate media filter, without the government propaganda, without the financial advisor doublespeak, smash that subscribe button, because this channel doesn't play games with your financial future. Here's what they're not telling you. In 1971, President Richard Nixon walked into a television studio, and with one 15-minute speech, he permanently severed your ability to exchange dollars for something real, something they couldn't print, something that had protected wealth for 5,000 years: gold. But here's the part that should make your blood boil. This wasn't a reaction to a crisis. This was the crisis they engineered on purpose. And right now, in 2025, as we stand on the edge of 2026, the exact same playbook is being run again, but faster, bigger, and with your retirement account as the collateral. Let me take you back to 1968, but I'm warning you, once you see this pattern, you can't unsee it. Officially, the story you were taught is that the London gold pool collapsed because of market pressure and that Nixon had no choice but to close the gold window in 1971 to protect American reserves. That's the sanitized version they print in textbooks. The reality is that 7 central banks, including the United States Federal Reserve, the Bank of England, and the central banks of Germany, France, Switzerland, Italy, and Belgium, formed a secret cartel in 1961 with one mission: suppress the price of gold to maintain the illusion that paper currencies were stable and trustworthy. For 7 years, these banks coordinated the sale of thousands of tons of gold into the market whenever the price threatened to rise above $35 per ounce, the official peg established at Bretton Woods in 1944. Why? Because if gold's price rose, it would signal to the world that currencies were being debased, that inflation was real, and that governments were printing more money than they had gold to back it. Sound familiar? Fast forward to today, and central banks are conducting the exact same operation. But now they use interest rate suppression, quantitative easing, and something called the Exchange Stabilization Fund to intervene in markets whenever asset prices threaten to reveal the truth about currency devaluation. Every time the stock market drops too fast, every time bond yields spike, every time gold rallies toward a psychologically important number, mysterious buyers appear with unlimited capital. Sound familiar? In 1968, the London gold pool failed catastrophically. France, led by Charles de Gaulle, stopped playing along and demanded the United States convert its paper dollars into physical gold as the Bretton Woods Agreement promised. Within months, the remaining pool members were bleeding gold reserves at a rate of hundreds of tons per week. Private investors around the world smelled blood and started a buying panic. By March 1968, the pool had lost over 3,000 tons of gold trying to defend the $35 peg. The Federal Reserve and the Bank of England held emergency meetings. They had 2 choices: admit the system was broken or double down on the deception. They chose deception. Here's the parallel you need to understand right now. In 2025, central banks are once again net buyers of gold at the fastest pace in decades, accumulating over 1,000 tons annually since 2022, while simultaneously telling the public through their media proxies that gold is a barbarous relic and that you should stay invested in stocks and bonds. Sound familiar? If gold is irrelevant, why are China, Russia, Poland, Singapore, and India's central banks buying it by the hundreds of tons every single quarter? Why did the People's Bank of China just report in November 2025 that it added another 23 tons to its reserves for the 18th consecutive month? Because they know what's coming. They know the dollar's role as the global reserve currency is on borrowed time, and they are preparing for the transfer of power that happens when one monetary system dies and another is born. Let me take you to August 15th, 1971. Nixon's announcement, officially called the Nixon shock, suspended the convertibility of the US dollar into gold. He said it was temporary. 54 years later, that temporary suspension is still in effect. What happened next is the most important financial event of the 20th century, and almost no one understands its implications. The moment the gold standard ended, every currency on Earth became a fiat currency, meaning its value was based solely on government decree and trust, not on anything tangible. This gave central banks unlimited power to create money out of thin air. In 1971, the total U.S. national debt was $398 billion. Today, in December 2025, it is $36.1 trillion, a 9,000% increase. Your dollar has lost over 98% of its purchasing power since 1971. But here's the mechanism they don't want you to understand. When money is backed by gold, governments cannot print unlimited amounts because they are constrained by their gold reserves. When money is backed by nothing, the only limit is political will, and political will always bends toward printing more, borrowing more, and inflating more. This is not capitalism. This is not a free market. This is a system designed to transfer purchasing power from savers to debtors, from citizens to governments, from the middle class to the asset-holding elite. The people who owned real estate, stocks, and gold in 1971 got richer as fiat currency was printed. The people who saved cash in bank accounts got silently robbed by inflation. And you won't believe the name of the man who designed the intellectual framework for this entire system decades before Nixon's speech. Let me introduce you to John Maynard Keynes. Keynes argued in the 1920s and 1930s that gold was a barbarous relic, and that governments should control money supply to manage economic cycles. His ideas were adopted globally after World War II and became the foundation of every central banking policy you see today. Keynes died in 1946, but his philosophy lives on in every quantitative easing program, every stimulus package, every bailout. What Keynes understood, and what his followers in central banks understand, is that if you control the money supply, you control human behavior. You control savings rates, risk-taking, investment, consumption, and political stability. Gold cannot be controlled. It cannot be printed. It cannot be hacked. It exists outside their system. That is why they had to kill it. That is why Nixon closed the gold window. That is why every financial media outlet tells you gold is a stupid investment while central banks quietly hoard it. Now, let me show you the receipt. Between 1971 and 1980, gold went from $35 per ounce to $850 per ounce, a 2,400% increase in 9 years. Why? Because millions of people around the world understood that their currencies were being destroyed, and they rushed into the only asset that could not be printed. The same pattern is setting up again right now. Gold hit an all-time high of $2,789 per ounce in October 2024. Silver, which has been suppressed even more violently than gold, is still trading 70% below its inflation-adjusted 1980 high of $125 per ounce. Do you see the asymmetry? Do you see the coiled spring? Let's dig into the mechanics of how this system works today and why 2026 is the inflection point. The modern financial system is built on 3 pillars: fiat currency, debt-based growth, and derivative leverage. Every dollar in circulation is created when a bank makes a loan. That dollar comes with an interest obligation. The system requires perpetual growth in the money supply just to service existing debt. If the money supply stops growing, defaults cascade, banks fail, and the system collapses. This is why central banks can never stop printing. This is why inflation is permanent. This is why your salary increases never keep up with the cost of housing, healthcare, and education. The system is mathematically designed to devalue your labor over time. Now add derivatives. The global derivatives market is estimated at over $1 quadrillion in notional value. That is 1,000 trillion. To put that in perspective, global GDP is roughly 100 trillion. Derivatives are bets on bets, claims on claims, leverage on leverage. They exist in a shadow banking system that operates outside traditional regulations. When these derivatives unwind during a crisis, the collateral calls are so massive that only central banks can provide the liquidity. This is what happened in 2008. The Federal Reserve secretly lent $16 trillion to global banks through emergency lending facilities that were not disclosed to the public until years later when Bloomberg successfully sued for transparency. $16 trillion, created out of nothing, lent to banks that should have failed, socialized losses, privatized gains, moral hazard on a planetary scale. And it is happening again right now, but the numbers are bigger. In March 2023, when Silicon Valley Bank collapsed, the Federal Reserve created the Bank Term Funding Program and injected hundreds of billions of dollars into the banking system within 72 hours. The media called it a success. What they didn't tell you is that the program allowed banks to borrow against their treasury holdings at par value, even though those treasuries had lost 20 to 30% of their market value due to rising interest rates. The Fed literally papered over insolvency with printed money and called it stability. The commercial real estate market in the United States is sitting on approximately $1.5 trillion in debt that is currently underwater as property values collapse and remote work eliminates demand for office space. Hundreds of small and mid-sized banks have massive exposure to these loans. When those loans default, and they will, The Federal Reserve will step in again, print again, and inflate again. This is the cycle. Crisis, intervention, inflation, asset bubbles, crisis. In every cycle, the people who own tangible assets get richer while the people holding cash and bonds get poorer. Gold and silver are not investments. They are insurance against this cycle. They are exits from a system that is designed to extract your wealth through invisible taxation called inflation. So how much do you actually need before 2026? The answer depends on what you are protecting against. If you believe the system will continue to muddle through with managed inflation of 3 to 5% annually, then holding 10 to 20% of your net worth in physical gold and silver is a reasonable hedge. But if you understand that the global reserve currency system is in its terminal phase, that central bank digital currencies are coming to replace cash and give governments total surveillance and control over your spending, that the BRICS nations are actively building an alternative trade settlement system backed by commodities to bypass the dollar, and that the next financial crisis will be met with money printing so extreme it will make 2008 and 2020 look like practice runs, then you need to be much more aggressive. Here's a framework. Start with a base position of 1 ounce of gold per family member. That is your insurance against currency collapse. Gold is for wealth preservation, not speculation. It has maintained its purchasing power for thousands of years. 1 ounce of gold bought a fine men's suit in Roman times, in 1920, in 1980, and today. Its value is stable. The currency's value is what changes. Silver is different. Silver is both a monetary metal and an industrial metal. It is used in solar panels, electric vehicles, electronics, and medical equipment. The above-ground supply of silver is smaller than gold because silver gets consumed in industrial applications, while gold is hoarded. The current gold to silver ratio is approximately 87 to 1, meaning it takes 87 ounces of silver to buy 1 ounce of gold. Historically, that ratio has averaged 15 to 1. When it reverts to the mean, silver will outperform gold by a factor of 5 or more. If you are younger and can tolerate volatility, silver is where you get leverage. A reasonable allocation might be 50 ounces of silver per family member as a starting position, scaling up based on your conviction and financial situation. But here's the critical part. It has to be physical. Not paper, not ETFs, not futures contracts, not digital claims on a blockchain. Physical metal in your possession or in a private vault you control. Why? Because every paper claim on gold and silver is leveraged. The COMEX gold futures market trades over 100 times the amount of physical gold that actually exists in its vaults. The London bullion market operates on unallocated accounts where hundreds of clients have claims on the same bar of gold. When confidence breaks and people demand physical delivery, these systems will fail. We have already seen it happen. In March 2020, the spread between physical gold and paper gold futures contracts blew out to $70 per ounce because there was no physical metal available for delivery while paper contracts traded freely. The system is fractional reserve, just like banking. It works until it doesn't. The smart money knows this. Why do you think central banks only buy physical gold? Why do you think billionaires like Ray Dalio publicly recommend 5 to 10% gold allocations? Why do you think the ultra-wealthy are buying farmland, energy assets, and precious metals while telling the middle class to stay invested in index funds? Because they understand the end game. They understand that when the debt spiral becomes unsustainable, when the bond market loses confidence in government solvency, when the derivatives bubble pops, the only assets that will hold value are those that cannot be printed, debased, or hacked. Land, energy, food, water, gold, silver. Everything else is a claim on a system that is built on borrowed time. Let me give you the timeline. In 2026, several critical events converge. The United States faces a debt ceiling crisis in the first half of the year. Regardless of which political party controls Congress, the ceiling will be raised because default is not an option, but the fight will be ugly and will erode confidence in U.S. fiscal stability. The European Central Bank is trapped between rising inflation and a fragile banking system that cannot handle higher interest rates. Japan is running a national debt to GDP ratio of 260%, the highest in the developed world, and is already intervening in currency markets to prevent the yen from collapsing. China's property market, which represents 30% of its GDP, is in a controlled demolition with developers defaulting and local governments unable to pay their debts. The global economy is not in a boom. It is in a credit-fueled illusion of stability that requires continuous central bank intervention. And the intervention is creating the next crisis. When you print money to solve a debt problem, you don't eliminate the debt, you monetize it, which means you transfer the loss from bondholders to currency holders through inflation. Inflation is not rising prices. Inflation is the expansion of the money supply. Rising prices are the symptom. The cause is central banks creating currency to buy government bonds, to backstop banks, to fund stimulus programs. Every dollar they create dilutes the value of every dollar you hold. This is why wages never keep up. This is why housing is unaffordable. This is why retirement seems impossible for younger generations. The game is rigged, and gold and silver are how you step outside the game. Here's the final truth they will never admit. The people who designed the system in 1971 knew exactly what they were doing. They knew that removing the gold standard would allow unlimited government spending. They knew it would create inflation. They knew it would transfer wealth from savers to asset holders. They made the trade-off deliberately because it gave governments power and flexibility. But power and flexibility in the hands of politicians always leads to the same place: excess, moral hazard, and eventual collapse. Rome debased its currency and fell. Weimar Germany printed money and got hyperinflation. Zimbabwe printed money and destroyed its economy. Venezuela printed money and created a humanitarian crisis. The United States is not immune to these laws. It is just larger and more complex, which means when it breaks, the consequences will be global and catastrophic. The question is not if, but when. And the answer is closer than most people think. We are in the late stages of a monetary experiment that has never worked in human history. Fiat currencies always fail. The average lifespan of a fiat currency is 27 years. The US dollar has been fully fiat since 1971. We are 54 years into an experiment that is already twice as long as the historical average. The only reason it has lasted this long is because the dollar is the global reserve currency, and the US military enforces its use through the petrodollar system. But that system is cracking. Saudi Arabia is now accepting yuan for oil sales. Russia and China are settling trade in their own currencies. The BRICS nations are building alternative payment rails. The world is slowly, then suddenly, moving away from dollar dependence. When that transition accelerates, the demand for dollars will collapse, and all those trillions of dollars sitting in foreign reserves will come flooding back into the US economy, chasing goods and services, driving prices to levels that will make today's inflation look mild. The Federal Reserve will have two choices: raise interest rates so high that it bankrupts the government through interest expense on the national debt, or print money to buy the bonds that foreign central banks are selling. Either choice leads to crisis. High rates mean depression. Money printing means hyperinflation. There is no painless exit. The only people who will be protected are those who move their wealth into assets that cannot be printed. Gold, silver, land, energy, commodities. The tangible, the real, the scarce. Everything else is a promise, and promises are only as good as the entity making them. Do you trust a government that is $36 trillion in debt and adding another trillion every 100 days? Do you trust a central bank that has expanded its balance sheet from $800 billion in 2008 to over $8 trillion today? Do you trust a banking system that required $16 trillion in secret loans just to survive the last crisis? If your answer is no, then you already know what you need to do. The time to prepare is not when the crisis hits. It is before. It is now. Right now, in December 2025, you still have access to physical gold and silver at prices that are reasonable relative to what is coming. You still have time to move wealth out of the system before capital controls, before bank bail-ins, before the panic. The majority will wait. They will wait for confirmation. They will wait for the mainstream media to tell them it is okay to buy gold. They will wait until the price has already doubled or tripled. And by then, the physical metal will be gone, premiums will be 40 to 50% above spot, and delivery times will be measured in months, not days. You are watching this video because you are not part of the majority. You are someone who questions the narrative, who does the research, who understands that the official story is always incomplete and usually designed to protect the interests of the people in power, not you. So let me ask you directly, are we wiser now, or are we walking the same path in better suits? Are we learning from 1971, from 2008, from every monetary collapse in history, or are we repeating the same mistakes with more complex instruments and bigger numbers? Share this video with someone who still believes their savings account is safe. Subscribe to this channel if you want to stay ahead of the narratives that are designed to keep you compliant and broke. And drop a comment telling me if you have already started stacking or if you are still on the fence, because the clock is ticking and 2026 is not going to wait for you to be ready.